Hello, ladies and gentlemen, and welcome back. The biggest economic news of 2023 is fast approaching. What is it? It's CPI inflation numbers. As we know, in 2022, this moved markets upwards of 5% in one day. And of course, that's for stocks, commodities, and cryptos. And we've been discussing all of those, and we'll be talking about them in today's video. But more importantly, we're reaching the level that we've discussed in some time, that 4,000 zone. A critical point with moving averages, Fibonacci's, trend lines, and everything else in its way. The market's probably about to make a decision on whether it wants to go further into the bullish territory for 2023, or we're about to see a potential epic reverse. Well, welcome back everyone to the Daily Show. We've got the news, the lead indicators, and of course the key levels that you should be watching. Make sure to follow at FX Evolution for some extra information as well that we don't share here on YouTube. But predominantly, let's start off with smart money versus dumb money, the last read of inflows from these ahead of the inflation. In the last couple of sessions, we've seen some nice rallies coming through, and those rallies have been, it looks like, spearheaded by what we call dumb money, generally retail traders and smaller investors. Smart money is kind of sat on the sidelines, and a lot of that has to do with they're going to make probably their decision leading into the economic data, finding out how this inflation read looks. Speaking of inflation, what's happened in the last 24 hours and what will happen in the next 24 hours is going to be super important to this number, the Federal Futures Fund rates. And probably 99.8% of people out there have absolutely no idea about this chart. So definitely subscribe to the channel, because this really is a game changer in understanding so many asset classes around the world. Firstly, what does it tell us? It tells us where the interest rate is most likely going to go based on the bonds market. And then it tells us how many cuts are expected and until when. Now, of course, it's always changing, and that's why you need to update these types of charts. But it's interesting to see, as of 2023, coming into this particular CPI inflation event, we've got some pretty drastic cuts coming through. And it's expected that we're going to need to do a lot of cutting in 2024. Notice also there's a bit of dialogue shift from the Federal Reserve and what the bonds market expects. The Fed is saying in 2023, they're not changing rates. The market is saying you're going to have to, because realistically, the economic conditions have gotten quite a lot worse. US Treasury yields is also something that a lot of people have been discussing in 2022 into 23. And the main reason is because everybody wants to be thinking about buying these TLT and other types of treasury bonds. They're well known to be good during what we call deflationary busts. And that's like a recession. Effectively, that's probably what we're in with the US. So here are some of the yields and the changes over time. Let's talk about the inflation number though. Here are some of the previous inflation numbers of 2022. And more importantly, the reaction of the S&P 500 after those numbers come out. Now, you'll notice that predominantly bad news is bad news and good news is good news for the market. And that's interesting. Sometimes in, I guess you would say, economic data, it's bad news is good news and all of those types of things. But realistically, with inflation, if the number comes in higher than 6.7 or even 6.7, you're probably expecting a red number based on what we've seen in the history. There's been a few that have come in online. Of course, why were they negative? Well, a big part of that was realistically the sticky inflation. Food and shelter are going to be two of the main components that a lot of people will be looking at in these numbers. What about inflation today versus the 1970s? A lot of people ask about this. Well, the good news is that traditionally when inflation has stopped kind of topping off, it's generally been, relatively speaking, a pretty smooth ride down. There have been some bumps, and of course we've seen bumps potentially coming forward, but this is usually the way that inflation works. It goes from a really high number down due to central bank policy tightening, which is what's happening. And of course, if there is a bad read, we have to think about, okay, what happens in the future? So first things first, of course, we've seen fertilizer costs coming down. This is going to take a little while to come through into the inflation figure, but fertilizer has dropped off a cliff. Most likely, since the China reopening story, that's going to actually spike a little bit. But effectively, US inflation should be expected to drop in food ideally. That's certainly not happening though in eggs and other things at this time. US-China freight has also come down. That's a good sign in the future for inflation, though do we get it in the current reading? And then of course also things like used car sales, energy, they're all expected to probably drop or at least remain sideways for now. And of course the used car meeting really shows us demand destruction here. If you're trying to sell your car, unfortunately, it was probably about 3 to 6 months ago that you were getting top dollar. If you haven't already, definitely consider checking out the FX Evolution competition. We're offering some free courses for 2023. All you have to do is fill in your name and email address, and in just under 5 days, we'll be doing a draw here. It's our little gift to say thank you so much for the support in 2022. And of course, if you do get the first prize, I'll be speaking to you in February. So I look forward to seeing whoever that lucky winner is at that point in time. We've now seen one of the most important figures that some people argue really details 2023. We've talked about this before. It's called the first 5 trading days of a year. And sometimes, well, actually statistically, it has proven to be a pretty good read of positive or negative returns over a year. Whenever you've seen these usually positive signs, you tended to lead into fairly substantial years. And the stronger that some of these reads were, the better the yearly returns. We've had an okay year, but just to put it in detail, this is what 2022 looked like. This year, it was positive. So will that mean that even if we go down during the first and second quarter, we return pretty well by the end of the year? There's certainly some major arguments to be made for that. And of course, we'll be breaking that down on this channel moving forward. S&P 500 inflection points are also really, really important. If we are going into recession, highly likely, I believe, in fact, most of our reads say we already are in one, then we have to expect that potential discounting of the market is possible. At the moment, we're sitting on, of course, 17 forward PE. And I've said this for a little while. During some of the declines, the major dips, you can go downwards of even 10, but realistically around that 14 to 15 is a very interesting period. If that does happen, of course, we'll be talking about it here on the channel, and specifically, we'll be mentioning some of the key levels that will be coming up into that. What could cause the market to go down? Well, it's not just inflation numbers this week. If they come in hot, the market's not going to like it because it's going to mean higher Federal Reserve terminal rates. But on top of this, we also have the beginning to kick off of earnings season with the banks. Citi, Wells Fargo, Bank of America, JP Morgan, they all start. Their airlines are coming in as well. This will probably tell us a lot about demand destruction and the general health of the US economy, which is going to be one of the most important stories and discussions of 2023. This is now probably going to move more from inflation after the first or second read of this year into how much damage have we done and how are we going to fix it? Can we even fix it with cutting rates? That's going to be, I think, one of the big discussions. So what's happened in the last 5 days? Well, it's all been about hypergrowth. Squeezes are back on. We'll show some charts later on today's video about that. But really, clean energy and solar have been the outperformers over the last couple of sessions. And we've been bringing these charts up for good reason. We've been talking about semiconductors and consumer discretionary finding buyers in the last couple of days. What this proves is it's really important to see the money flow. And charts like this, I think, are quite unique because a lot of retail traders don't think about markets as sectors and money flow going in and through all of these different areas throughout years. And this happens every single year, whether it's a crash, whether it's something else, there's always a flow. And this is something that when I first got into trading, I found out about, and I was really, really excited about it. And of course, this is something I built many systems around, understanding flow and following that to get that kind of bigger money moves. So what happened in the last 24 hours? Well, TAN and PBW, that's clean energy, did the best. REITs did okay, interestingly. And then we had consumer discretionary. That was probably my peak of the last 24 hours. I thought stocks like Amazon could do quite well. If anyone's in our private community, you would hear me say that I thought the Amazon was the play there. And then, of course, XLK did okay. Semiconductors did well as well. So it was a pretty good session. It pushed us to a new high. And it probably took a lot of people's stop losses out, which we'll see when we look at the S&P 500 analysis very soon. The VIX, the volatility index, remains probably a little bit lower than most people would expect coming into this inflation number. This could be a very interesting read over the next 24 hours. If the VIX goes underneath, let's say 18, that will be the first time it's happened really since this whole thing started in 2022. And that could mark a big decisional change that we have to make in markets. But for now, it's above 20, which means that we still have a lot of volatility in markets. As we saw before, there's expected further rate cutting in the future. Depending on the inflation numbers, we'll probably see a little bit of a move out of TLT. This is the 20-year Treasury bond. And at the moment, it's kind of make a peak. It's moved down and it's still starting to rally. A lot of people believe this will be one of the better investments of 2023. I can't really deny that I tend to agree with it, though price is everything. And of course, timing is everything with these types of charts. But historically, during deflationary busts, Treasury yields and bonds have tended to do quite well. High yield junk had another good session, kind of proving that maybe this move was correct. We will be doing a further study on high yield junk, corporate bonds, and of course TLT and whether they're disconnected from the market. But for now, it was a pretty strong session. It didn't show us anything ahead of the inflation numbers that this current rally was some kind of, maybe you would say, bull trap or anything like that. However, we will look at the prices very, very soon. Dollar index remains at an incredibly critical zone. You can see this trend line of 2022. You can see the distribution, the false break to the upside, the sell-off. If we take a look at that on a weekly, you'll notice how negative it really looks for the US dollar. But guess what? It's at a critical point, and that's ahead of course, the big economic news. Yes, everything really is going to be very interesting about the DXY in the next 24 hours. I'll be watching it. We've got alerts here, and of course, you'll want to have alerts down the bottom as well for breakouts. And it could be a pretty wild time for the US dollar. So certainly currency traders will need to be careful there. Gold was an interesting one. It broke high, then fell super heavily down, and it actually made it through that 1870 zone, which we'd been thinking about as purchasing levels for quite a few days and had been quite successful there. It then made a new low, but didn't get underneath 1866. So I think that's really important when we're taking a look at this market. There was a switch. It's like a high, low, higher, high, and then we got a lower low, but we didn't take out this area. Yeah, I think we're coming up to a critical zone around 1881 to 80 should be a critical area. I wouldn't be surprised at all for the market to be there ahead of inflation. And if selling's going to ensue, potentially it comes off that zone. Be very careful, those spikes, bid ask, all of these types of things will tend to get very wide during reads such as this inflation number. You've got to be very, very careful. What about US oil? Well, it couldn't get through that trend line. It's belted back up here. We're back above 77. And the way that we've done it is not necessarily as easy to be a shorter anymore. We initially liked the idea of it getting to 77. It stopped early, came down, made the trend line. Obviously didn't make the new low to give us that idea of the 66, 65 being a thing. And at this stage, we find ourselves at 78. Could it shift here? Of course, we have a lot of supports that could become resistance. It's a critical level for US oil, but again, it's happening ahead of inflation numbers. We'll find out quite a lot. A few people have been messaging me as well and saying this is like a head and shoulders pattern with the neckline down here. Again, for further shorting of oil, you're really needing it to move back down to these levels. And at this stage, we're looking for some type of shift, and we just haven't seen that yet. At the moment, it's all bullish and no bears recommitting to the trade at this stage. Let's move over to Tesla and the stocks around the markets at the moment. And I think the big one is Tesla, while it moved a lot, 3.68% on the day, it's mostly been showing itself to potentially be accumulating position. I expect Tesla to probably remain relatively maybe range bound for a few sessions, maybe even a few weeks. The one thing that is very, very interesting is what's going to happen with next week's options expiration. So let's have a quick look at the options first. So the 13th of January, that's the Friday this week, we have to expect that the market will want to ideally remain within kind of the boundaries of maybe like a 130 and a 120-ish. That zone would be pretty good for the options traders. It doesn't mean it has to, but of course you can see here the big levels. As we move forward to the 20th though of January, the change in open interest amount goes over 3 million units. And at that point, you can see here the max pain is currently 140. So could that be realistically pushing Tesla up a little bit more to the 130s, 140s even in this potential false rally? Yes, I think that options are going to be super key to the next week, but Tesla is its own entity at the moment. It was so heavily sold that everybody thought it was worth $60 all of a sudden and started buying 100 puts. That 100 level remains that huge put wall. And realistically, at this stage, it's probably putting a lot of pressure on those ahead of expiration. We'll revisit Tesla a lot, I think, after the inflation numbers and into the next week. That's when it's going to be the most interesting. Apple ended up making a new high on the close and changed, of course, the expected weekly options highs and lows. We ended up moving pretty strongly on this pair. And if we take a look at the weekly, it's really in line with our thoughts coming into this week, which was rejection wicks and strength. So even with that false Monday narrative of that really nasty looking shooting star into the inflation numbers, markets are certainly rallying. And on paper, if you showed most people these charts, they'd be looking at it going, damn, that looks pretty damn good to give you even further gains in the future. Let's have a look at a couple of exhibits. First up, we'll look at the island reversal here on AMC. Anyone that actually got this in the last 24 hours, not a bad trade in the squeeze side of things. Do I still like it? Well, not really, because we're going into inflation, but this was a great day trade. Even if you're not a squeeze trader, which I wouldn't blame you to be because it's pretty wild. All the squeezes were pretty much showing up this way. But as we've seen before, ahead of big economic news, sometimes AMC has shown us when, let's call it dumb money or retail money, is getting a little bit frothy. Usually we've had these larger moves, which have helped us to figure out that markets were false moving to the upside. We haven't seen that strongly yet, but we certainly have seen one day of pretty exuberant retail buying across BBBY and all sorts of other squeeze stocks. We've also seen Amazon flying over here. This was a pretty nice one. Of course, the negative side would have been if it opened down, that would have probably that would have forced through an island reversal there. It didn't do so. The big thing was the NFP here, and look at how fast that thing has recovered. This is just the type of thing that happens with things like consumer discretionary and growth stocks when they start ramping. 16.57% off the bottom. That's a lot for one of the biggest companies in the world. If we go over to the weekly again, it's coming through those multiple wicks, which showed us the buyer demand. And at this stage, it's been a good week for this one. Congrats if you've held on to Amazon ahead of inflation. Now we'll find out what those numbers do. Consumer discretionary versus staples broke out a day ago. Of course, another huge run on how strong consumer discretionary has been in comparison to the defensives. That money flow rotation really at work here. Are we seeing anything else that's interesting? Well, I think the big ones have to be small caps. So if you notice here, the US 2000 broke and closed above that big Monday rejection shooting star. That showed us that most likely people were trapped in shorts here that probably shorted through this session. They were squeezed here and then were squeezed through the entire thing into CPI. I think a lot of bears have been trapped into a narrative probably on Tuesday to get super short. And then now they've been squeezed for 2 days ahead of CPI, potentially losing their positions in the last 24 hours. And that's an important storyline or thought process to go into with these markets. We've also had things like ARK, smaller caps in general, having incredible squeeze rallies on them, again, putting pressure on a lot of those puts. And it opens up the ability for the market just to go back down potentially to here, expire puts that are worthless in January 20th, which is, of course, going to be where there's heaps of large puts down there, and then potentially make the next decision. So it's an interesting thing occurring in these markets, but we have seen a big resurgence of really high, what was perceived as high risk style trading stocks, things like clean energy, solar, ARK, XLY, all of these types of sectors. It's really come through. Luckily, we kind of spotted it a few days ago, and we've talked about it here quite a lot on the channel. Let's move over to the 2 hour. As you saw in the weekly, there was a lot of rejection wicks for the US 100, and it actually hit one of our alerts in the last 24 hours. It broke every single one of these highs, and it found itself at that 11,400. Is this the turning point for something like the Nasdaq? Well, we know that there was a huge amount of support, which could become resistance, sitting around just above around that 11,500 level. But really, it comes back to the SPY, which is the key zone here. Here's the expected weekly options highs and lows. They've moved a little bit, 403 almost on the SPY, 388 on the low, coming after the inflation numbers and after the big banks do their earnings reports. But let's take a look at the SPX. We have the 200 moving average, the 61.8 fib pullback, the gap fill of 39.95, 4,000, the psychological level of 4,000, and everything's kind of moving towards that area. And we suspected this would occur, and this was the trap to stop you into this. I'm sure a lot of people have been stop loss hunted here. A lot of people have been squeezed out, and now we find ourselves at a super critical zone ahead of this news. And realistically, at this level, what do we have to think about? Well, if the market comes out and initially spikes, then dumps, that'll be similar to what's happened before after inflation numbers. Let's take a look here at the futures just to see some of the previous inflation number results. We saw down here an inflation number result where it went one direction, then instantly rejected, and of course made a significant switch to the trend. We've also had other numbers that have just started incredible rallies, huge moves here. And I think this is the one I want to point out. So this was a number that happened a little while ago, back in September of 22. And what you'll notice is that the market was rallying pretty strongly. It hit a level. It actually rallied initially at the number and then just got absolutely destroyed. So these are the things that are at stake during inflation numbers. Effectively, things upwards of 5% for the session. Huge moves, very volatile events, and you have to have your proper risk management in place. Will we see a clean read? That's also going to be very important. We saw before that if expectations are not met, let's say they're equal, or of course inflation comes in hotter than expected, even if it does rally, you have to expect probably to the downside. That's a guess. It's an educated guess based on the data, but it is bad news probably is bad news in this case. So will we get a spike into this level, then a potential short off? Let's look at the quick evidence here. We've got the downward trend line that was the trend line of 2022. We have spiked it before, but we've never closed above it. That'll be a very, very interesting point if that does happen. We have the gap close, the daily level, the monthly level, and then of course the Fibonacci zone and a 4K with a bunch of options sitting on it. Let's have a look at the options. 13th, here's the 400, not huge, but 18,719. It's the biggest call strike that we have leading into Friday. And of course, anything between kind of like a 380 and a 400 is fair game here this week. Max pain, very, very strong. A lot of puts, again, expiring worthless, which has been the story of the last couple of months. Everyone's trying to short, everyone's bearish, but it's all about timing, and that really is super important. The 20th of January, here it is, and you can see that there's so many puts. So again, if we push that 400 narrative, then we start to sell off. Let's say we push the 400 narrative, even push past it, wick back below, and grab a whole bunch of calls in. Remember, as long as the market kind of stays above 380 next week, it's making so much money from expiration of all of these puts. 5 million units. That's a lot. So 5 million units of options expiring as of the 20th of January, right into the earnings season. It's a very exciting time in markets, but always expected to be volatile. What did crypto do? If crypto does lead markets, you would think, of course, it's going to be bullish. It absolutely flogged through our 17.5, 17.6 zone. There was no signs of even a slight pullback through that area. We'd speculated this was a good take profit area. Obviously, it was a potential reversal. We didn't get any signals in there. There was no very strong movements towards the downside or anything. And then we've moved all the way back up. We've had this line in here for a while, which is that 18,400. And Bitcoin is again leading the charge. Ethereum now set off our alert, getting through the 1,355 zone. And potentially, if the CPI number is good, there could be further upside for something like Ethereum to follow in Bitcoin's footsteps. Bitcoin's sitting at that almost, really high kind of high that we've seen for quite some time. And if we do get a breakout from this level after inflation, could it be that crypto is actually leading into 20,000 or even 21,000? These are going to be critical levels moving forward in 2023. So a nice breakout here from crypto, bit stronger than even we thought it would be. And we find ourselves at, as you can see, another critical zone ahead of CPI. This is one of the good things about news. Sometimes if you have a directional trade and you believe in a certain level, often the market will go towards that level ahead of the news because it needs the news to break that zone. And that's what we've seen here on the stock market. And it looks like we've seen it on the crypto market as well, with a critical level being achieved. Will it break it, or is it going to reverse? Now it's up to the news. And that's really the story of today. Let's have a look at the news coming through. Of course, CPI is 8:30 a.m. New York time. Then we scroll down to prelim UOM consumer sentiment, 10 a.m. And we also have the big kickoff to earnings. Remember, the banks come out on Friday, and that's the beginning of the US economy showing us whether there's demand destruction or things are still a little bit hot. It's going to be a very interesting 2023. It probably is the year of the trader again. And I believe it's the year of the investor as well. If we do get some of the big, let's call it highlight kind of potential here to get those VIX 45s, then it really could be the year of the investor. So make sure to subscribe, smash that like button, and as always, enter the giveaway. Links in the description down below. It's free to do so, so why not give it a shot? See you soon.